Okay, so you want to own an AI data center, not an AI startup, the actual building where the machines live. A market can have almost no vacancy and still bankrupt the person who built the wrong facility. Okay, so you want to own an AI data center. Half a megawatt can be a business. 500 megawatts is an energy project with data halls attached, not shares in NVIDIA. A cheap parcel without deliverable power is not a data center site. It is expensive dirt. Not a software company with the word AI added to its pitch deck. The customer is not really renting square feet. The customer is reserving reliable kilowatts. You want to own the physical building where the machines actually live. The first megawatts cover the machine. The last megawatts create the return. And on paper, this sounds almost unfairly attractive. Good buildings can survive. The equity wrapped around them may not. Same 10-megawatt plan. One pays its owners. The other needs $8 million a year just to stay alive. Technology companies are spending enormous amounts of money on artificial intelligence. In early 2026, vacancy in the tightest major American markets fell toward 1% or below. Northern Virginia, the largest data center market in the world, reached roughly 0.3%, while Atlanta fell to about 1%. Much of the capacity now under construction is already committed before the doors even open. So you find some cheap land, put up a large concrete box, connect it to the grid, and rent space to companies that are apparently willing to buy every megawatt they can find. Simple. Except your concrete box may cost more than $100 million. Your electrical connection may take 4 years. Your customer may want a cooling system that did not exist in your original design. Your neighbors may decide they hate you. And even if the building is full of valuable computers, you can still lose the entire business because the debt was structured badly. That is the paradox. A data center can have almost no available space, rising rents and customers begging for capacity, and still be a terrible investment for the person who built the wrong facility in the wrong place with the wrong financing. By the end of this video, we are going to price 3 different ways to enter this business, break down where the revenue actually comes from, look at one operator that built a powerful moat and another that collapsed under its capital structure, and then build 2 10-megawatt projects from the same basic plan. One will generate a healthy return. The other will lose more than $8 million a year. And the difference will not be artificial intelligence. It will be what happened before the first server ever arrived. The first thing you need to decide is what the phrase "own an AI data center" actually means, because there is a very big difference between owning a small regional facility and developing a campus that consumes hundreds of megawatts. For the rest of this episode, our main owner will sit in the middle, a 10-megawatt AI-ready wholesale co-location facility. The smaller and larger versions show how the same underlying business changes at the edges. At the smallest realistic level, you might acquire or build a facility with roughly half a megawatt of critical IT capacity. This is not where a frontier AI model is trained. It may support selected inference workloads that benefit from being closer to users, along with local cloud infrastructure, backup systems, and other latency-sensitive equipment. Your customers could include local healthcare networks, financial firms, manufacturers, telecom companies, and regional cloud providers. A half-megawatt facility can still require a serious electrical system, backup generation, cooling, security, and redundant fiber. Because many fixed costs do not shrink neatly with the building, a small site can cost roughly $8 to $15 million all in, depending heavily on the existing structure, local utility work, and redundancy standard. This is the closest thing in the industry to a conventional entrepreneurial purchase. You may be able to acquire an older operating facility, improve its power density, add liquid cooling capability, and sell smaller blocks of capacity at higher retail rates. But there is a trade-off. The project is smaller, Yet your customers are usually smaller too. They have weaker credit, shorter contracts, and a higher chance of leaving. Now imagine a 10-megawatt building. This is large enough to serve serious enterprise customers, cloud providers, and AI companies, but still small enough to develop as a single regional project rather than an entire industrial campus. At 2026 construction costs, a modern facility can easily require $120 to $160 million after land, utility infrastructure, professional fees, financing costs, and contingency. This is where the business starts to look less like buying commercial property and more like assembling a private equity deal. You probably have a developer. You have an operating partner. You have a construction lender. You may have an infrastructure fund providing equity. And you desperately want at least one anchor tenant before you finish the building. At the top end, you are not building one data center. You are building a power market with walls around it. A hyperscale AI campus may plan for 100, 300, or even 500 megawatts of capacity across multiple buildings. JLL estimated the average global construction cost would reach about $11.3 million per megawatt in 2026, and difficult markets can run much higher. Equinix and PGIM Real Estate announced a $600 million joint venture for an X-scale facility in Silicon Valley, expected to provide more than 28 megawatts at full build-out. That joint venture value is equivalent to more than $21 million per planned megawatt, but it is not a clean construction cost benchmark. And those numbers describe the data center infrastructure. They do not necessarily include the customer's GPUs. At the 100 to 500 megawatt campus scale, the customer's computing equipment can add several additional billions of dollars to the value sitting on the site. At this scale, you are not a wealthy person buying a building. You are a development company backed by pension funds, private equity, sovereign capital, banks, and a customer whose credit rating may determine whether the project gets built. But all three versions, half a megawatt, 10 megawatts, or 500, are built around the same scarce asset. Power that is available in the right place, at the right price, on the right date. And that changes the first step of the business completely. In most real estate businesses, you begin with a property. In this business, that can be a very expensive mistake. 100 acres of cheap land beside a highway may look perfect. It may have room for multiple buildings, easy construction access, and a local government promising tax incentives. But if the utility cannot deliver power, you do not own a data center site. You own industrial land with an ambitious presentation. The process begins with a utility study. How many megawatts can the local grid deliver today? How many could it deliver after a new substation? Does the transmission network have capacity? Who pays for the upgrade? When will transformers and switchgear arrive? And is the utility's estimated delivery date a contractual commitment or just a polite guess? CBRE reported that power cost and delivery speed had moved ahead of pure connectivity as the dominant site selection issue. For very large campuses, developers may now prioritize whether 300 megawatts can be delivered within 36 months. When new transmission or generation is required, the timeline can stretch to 24, 36, or more than 48 months. That means the most valuable document in your entire project may not be the deed to the land. It may be the executed utility service agreement, or another binding service commitment that turns an estimated power date into a contractual obligation. Next comes fiber. A data center needs more than one path to the internet. If both fiber routes enter through the same trench and one excavator cuts that trench, your redundancy was just an illustration. Then you investigate water, depending on the cooling design. You check flood risk. You check aircraft paths, seismic conditions, and nearby industrial hazards. You investigate tax policy. And now, in 2026, you investigate whether local residents believe your project will raise their electricity bills, consume too much water, create noise, or provide too few permanent jobs. This is not theoretical. Local opposition has delayed or blocked billions of dollars of American data center development. In July 2026, Reuters reported that QTS, a major operator owned by Blackstone, had canceled a large Virginia project amid local opposition and legal challenges. So, before you buy the land, you need three forms of permission. Permission from the grid, permission from the government, and increasingly, permission from the people who live beside it. A cheap parcel without those permissions is not an opportunity. It is expensive dirt. Let us assume you found the right site. Now you can build the giant warehouse full of computers. Except the computers may be the one thing you are not buying. In a co-location model, your customer usually brings the servers. You build everything required to keep those servers alive. Start with utility power. Electricity enters the site at high voltage and moves through substations, transformers, and switchgear. From there, it passes through systems designed to prevent a single component failure from shutting down the customer. You install uninterruptible power supplies and batteries to bridge the gap between a grid failure and the moment backup generators take over. You install generators large enough to carry critical loads. You store fuel. You install fire detection and suppression systems. You build secure loading areas, fences, cameras, and controlled access. And then there is cooling. Traditional server rooms might have used 5 or 10 kilowatts per rack. Modern AI systems can demand many times that amount, concentrating enormous heat in a small area. That may require direct-to-chip liquid cooling, rear-door heat exchangers, or other high-density systems. If your building was designed for yesterday's servers, a customer can love your location and still reject the facility because the cooling system cannot support the rack density. This is why a megawatt of utility power is not automatically a megawatt you can rent. The building consumes some power itself. Cooling systems, pumps, fans, lighting, and electrical losses all sit between the grid and the customer's servers. The relationship is summarized by power usage effectiveness, or PUE. If your 10 megawatt IT load operates at a PUE of 1.3, the facility needs roughly 13 megawatts from the grid while fully loaded. 3 megawatts are supporting the 10 megawatts that customers actually use. And the owner cares deeply about that difference. If electricity is reimbursed by the tenant, efficiency still affects pricing and competitiveness. If you absorb part of the energy cost, poor efficiency can directly destroy your margin. If local regulators or utilities charge you based on peak demand, one badly managed month can become very expensive. Then there is redundancy. A customer does not just ask whether you have a generator. The customer asks what happens when the utility fails while one generator is under maintenance and a switchgear component refuses to transfer. Every promise of uptime adds equipment. Every layer of equipment adds cost. And every piece of equipment eventually needs maintenance or replacement. You are building a machine whose job is to make thousands of other machines forget that the physical world exists. Every system you just bought exists to support one product, a kilowatt the customer can trust. Now we can finally sell it. The obvious answer is rent, but data center revenue usually has several layers. The central product is not square footage. It is usable power. A customer reserves 200 kilowatts, 1 megawatt, or 20 megawatts of critical capacity and pays a monthly rate based on that commitment. At the end of 2025, CBRE reported an average asking rate of roughly $196 per kilowatt per month for requirements between 250 and 500 kilowatts across primary North American wholesale co-location markets. In early 2026, Quoted ranges reached roughly $200 to $230 in Chicago and $190 to $235 in Northern Virginia. Those are asking rates for smaller wholesale requirements, not a universal rate for a 5, 10, or 20 megawatt tenant. Rates vary dramatically by market, deployment size, contract structure, redundancy, and whether power is included. Larger tenants have historically received volume discounts, although tight contiguous supply has reduced some of that advantage. A hyperscale tenant taking 20 megawatts may negotiate a lower unit price than a customer taking 300 kilowatts. But the hyperscaler can fill an entire phase of your project with one contract. The smaller customer may pay more per kilowatt, but you need sales staff, customer support, and dozens of contracts to fill the same building. The tenant's power consumption is often billed separately or passed through under the lease. This can create a very large revenue line, but it should not be confused with a large margin. If you collect $10 million for electricity and send almost all of it to the utility, you did not create $10 million of profit. Your economics come from the capacity charge, operational margin, and the efficiency of the facility. This is the quiet, high-value product. Customers need direct connections to telecom carriers, cloud platforms, financial exchanges, and other companies inside the same ecosystem. Every cross-connect may look like a cable between two cages. Economically, it can become a recurring toll. The more customers and networks inside the facility, the more useful the facility becomes. And the more useful it becomes, the harder it is for customers to leave. Your staff may reboot equipment, replace cables, inspect hardware, or perform other tasks for customers who do not keep employees on site. You can sell security services, migration help, managed infrastructure, and support. These services are small compared with rent in a hyperscale building, but can meaningfully improve the economics of a retail co-location. Facility. At the very large end, you may create value before the facility is fully operating. If you control powered land, permits, and assigned customer, an infrastructure investor may buy into the project or finance the next phase. Equinix has repeatedly used joint ventures to develop hyperscale xScale facilities while retaining an operating and equity interest. In other words, you can make money by operating the data center. But you can also make money by de-risking the site enough that institutional capital is willing to own most of it. The mistake is assuming that every dollar of revenue is equally valuable. A one-year contract with a fragile AI startup is not the same as a 15-year commitment from a global cloud company. One may pay a higher rate. The other may allow you to borrow hundreds of millions of dollars. Let us reduce the entire business to 1 megawatt. Suppose a smaller wholesale deployment can be marketed at $190 per kilowatt per month. That creates $2.28 million of annual base rent before electricity reimbursements, services, concessions, and operating costs. 1 megawatt, $2.28 million a year. That sounds wonderful until you remember what it costs to make that megawatt rentable. At JLL's 2026 global construction estimate, the physical facility alone averages more than $11 million per megawatt. Your actual project may be lower in an inexpensive market or much higher in a constrained location. Then you add land, utility work, financing costs during construction, operating reserves, sales commissions, tenant improvements, and the capacity you built but have not leased. This is why occupancy has such violent leverage. The security team still shows up when half the building is empty. The control room still operates. The generators are still maintained. Insurance still renews. Property tax still arrives. And the bank does not reduce the payment because your sales pipeline sounded optimistic 6 months ago. A hotel can close a floor. A data center cannot casually shut down half of its electrical infrastructure while the other half is supporting critical customer systems. The first few megawatts help cover the fixed cost. The later megawatts create the return. This is also why pre-leasing matters so much. CBRE expected under-construction pre-leasing to remain around the mid-70% range in 2026, compared with a historical norm closer to 40 to 50%. Developers are not simply building and hoping. They are trying to transfer demand risk to the customer before pouring all of the capital into the site. And the customer often agrees, because waiting for an empty building may mean waiting years for power that has already been reserved by somebody else. The owner and tenant are both afraid of the same thing: missing the megawatt. The architectural rendering shows clean white buildings, landscaped grass, and a glowing AI logo. It does not show your interest expense. Your lease begins on a date. Your loan begins on a date. The utility and equipment suppliers are not obligated to respect either one. If a transformer arrives 12 months late, the building may be physically complete, but economically useless. You continue paying interest. Your tenant may have termination rights. Your construction team may remobilize. And the market window that justified the project can move on without you. A low-cost power market can become expensive. Utilities can create new rate classes. Grid congestion can increase charges. Regulators may force large load customers to fund more of the infrastructure required to serve them. In 2026, power demand and the question of who pays for new generation and transmission became a national political issue in the United States. A 20-megawatt lease from one cloud customer feels safer than signing 40 small customers. It also gives one company enormous power over your building. If the tenant delays deployment, renegotiates the contract, or decides that the location no longer fits its network, a large portion of your project can become exposed at once. Equinix reported more than 10,500 customers at the end of 2025, with no single customer representing 10% or more of annual revenue. A new hyperscale development may have the exact opposite profile, one tenant supporting nearly the entire financing package. The building may last for decades. The preferred server architecture may change in a few years. If customers move toward higher-density liquid-cooled systems and your halls were designed around lower-density air cooling, retrofitting can be expensive and disruptive. You do not need to predict every future chip, but you need enough electrical and mechanical flexibility that the building can survive more than one hardware generation. The customer is paying you to make failure boring and rare. A power outage can trigger service credits, reputational damage, and contract disputes. Redundancy lowers the probability of failure. It does not eliminate human error, maintenance mistakes, or cascading component faults. A project can satisfy engineering requirements and still lose politically. Residents may oppose transmission lines, backup generators, water consumption, noise, or tax incentives. A developer who treats the community meeting as a final administrative step may discover that it was actually part of the capital stack. And finally, debt. Data centers can produce long-term recurring revenue, which makes lenders love them. The buildings also require enormous upfront capital, which makes owners dependent on those lenders. If the project matures when credit markets are weak, or if leasing has not reached the level promised to the bank, the building can be full of valuable infrastructure and still run out of financial oxygen. That brings us to two very different owners. In 1998, Al Avery and Jay Adelson founded Equinix as a vendor-neutral, multi-tenant data center provider. The idea was not simply to rent secure space. It was to create a neutral location where competing networks could connect and exchange traffic. That distinction became the moat. A generic warehouse becomes easier to replace as more warehouses are built. A dense ecosystem of customers, carriers, and cloud connections becomes harder to replace as more participants join it. Moving one server rack is manageable. Rebuilding hundreds or thousands of business connections somewhere else is not. By the end of 2025, Equinix reported more than 10,500 customers and operational uptime above 99.9999% across its global portfolio. No single customer contributed 10% or more of annual revenue. In the first quarter of 2026, the company reported 12% year-over-year growth in monthly recurring revenue on an as-reported basis and said its stabilized assets continued to generate a 26% cash-on-cash return. That is a company-reported portfolio measure for stabilized assets, not a promise that every new data center earns 26%. And it is not directly comparable with the leveraged equity yield in the simplified project model we will build later. The lesson is not that every owner should copy Equinix's exact strategy. The lesson is that the strongest asset was not the concrete. It was the combination of scarce infrastructure and customer relationships that became more valuable together. For a hyperscale AI campus, the moat may look different. You may not have thousands of interconnected retail customers. Your moat may be a 500-megawatt power position, a permitted campus, and a long contract with a global technology company. But the principle is the same. The building is valuable because leaving it is difficult. Power is difficult to replace. Connections are difficult to replace. And once a customer has installed billions of dollars of equipment, moving is not like changing offices. A good data center does not merely contain the customer. It becomes part of the customer's system. Equinix shows what happens when infrastructure creates a network moat. But even useful infrastructure cannot protect an owner from the wrong capital structure. Now look at Cyxtera. Cyxtera was not a fake company with an empty field and an AI presentation. It operated a large global co-location business. It had real facilities, real customers, and real revenue. But it also carried a very heavy financial structure. At the end of 2021, Cyxtera reported roughly $976 million in capital lease obligations and about $908 million in long-term debt under senior secured credit facilities. In 2023, the company filed for bankruptcy protection while facing a severe funding crunch and difficulty paying down debt. Its assets did not disappear. Brookfield later entered an agreement to acquire substantially all of the company's business through the restructuring process. This is an important distinction. The data centers could remain useful. The customers could remain connected. The new owner could continue operating the platform. But the previous ownership structure could still be destroyed. That is the danger of confusing a good industry with a safe investment. Demand can be strong, vacancy can be low, rents can rise, and the equity can still be wiped out if the project carries too much debt, refinances at the wrong moment, or takes too long to stabilize. The AI boom increases this risk because the checks are getting larger. Reuters reported that AI data center and project financing deals reached about $125 billion during 2025, up from roughly $15 billion over the comparable period in 2024, according to UBS data cited by the news agency. More money allows more projects to be built. It also allows more mistakes to be built at enormous scale. So let us take the same 10-megawatt plan and change only the decisions made before the first full operating year. You are developing a 10-megawatt regional co-location facility in an expanding American market. The project is fictional, but the assumptions are built around current construction and asking rate ranges. Your total all-in development cost is $140 million. That includes the building, electrical and mechanical systems, land, utility work, professional fees, financing costs, and contingency. You finance 65% with long-term debt. That is $91 million of debt and $49 million of equity. Before full construction, you sign one 5-megawatt anchor tenant. Then you lease another 3 megawatts to several smaller customers. In the first full stabilized operating year, 8 megawatts are installed, commissioned, and paying rent. The 5-megawatt anchor tenant pays $170 per kilowatt per month. The remaining 3 megawatts are spread across smaller wholesale deployments at an average of $195. That produces $10.2 million from the anchor lease and $7.02 million from the smaller deployments. Total annual base rent is $17.22 million. Interconnection, remote hands, and other service revenue add another $1.8 million. Total recurring revenue, excluding electricity reimbursements, is $19.02 million. Now subtract operating expenses. Staffing and security, $2.1 million. Maintenance and service contracts, $1.8 million. Insurance and property expense, $1.4 million. Sales, administration, and other facility costs, $800,000. Total operating expense, $6.1 million. That leaves $12.92 million of property-level operating cash flow before debt service, taxes, depreciation, and capital reserves. The $91 million loan carries a 7% interest rate and amortizes over 25 years. Annual debt service is approximately $7.81 million. After debt service, you have roughly $5.11 million. Set aside $1 million for recurring capital replacements and reserves. Your pre-tax cash flow to equity is now approximately $4.11 million. On $49 million of invested equity, that is roughly an 8.4% annual cash yield. Not spectacular for a risky development, but respectable, especially if rents escalate. The remaining 2 megawatts lease up, and the stabilized building can later refinance at better terms. More importantly, the downside was controlled before construction. You secured power. You secured an anchor tenant. You matched the first phase to actual demand. You did not need the AI market to become even crazier. You only needed the signed customers to pay. Now you develop the same planned 10-megawatt capacity from the same basic design, but this time you begin with the story. AI demand is exploding. Vacancy is near 1%. Every conference panel says the world needs more capacity. So you buy land quickly and start construction without an anchor tenant. The utility connection is delayed. Equipment costs rise. Interest accumulates. Your total project cost increases from $140 million to $155 million. You still finance 65% with debt. That gives you roughly $100.75 million of debt and $54.25 million of equity. By the time the facility is ready, several large customers have already reserved capacity elsewhere. In the first full operating year, only 3 megawatts are installed, commissioned, and paying rent. Because the site is not in the strongest network location and you need occupancy, your average rate is $170 per kilowatt per month. 3,000 kilowatts multiplied by $170 and 12 months creates $6.12 million in base rent. Services add $600,000. Total recurring revenue, excluding electricity reimbursements, is $6.72 million. Your operating expenses do not fall by 62% just because the building is mostly empty. You still need operators, security, maintenance, insurance, taxes, monitoring, and sales. Total operating expense is $5.7 million. The building produces only $1.02 million before debt service. The larger loan, at the same 7% rate and 25-year amortization, requires approximately $8.65 million per year. Add $700,000 of capital reserves. Your pre-tax cash flow is now negative by roughly $8.33 million per year. You invested more than $54 million of equity, and instead of receiving a return, the owners must contribute more cash just to keep the project alive. The building is not technically broken. The market is not necessarily oversupplied. The three customers may be perfectly happy. But the capital structure was built for 8 or 9 leased megawatts, and the owner only sold 3. To reach break-even after reserves and debt service, you need roughly 7 megawatts leased at similar economics. Until then, every month becomes a negotiation between the owner, the bank, and time. This is why the most dangerous phrase in data center development is, "Demand will be there when we open." Demand may be there. It may simply belong to somebody else's powered site. So, should you build one? At the small end, possibly. At the large end, not by beginning with a building. The rational entry strategy is to remove risk in the correct order. First, identify a market where customers need capacity. Second, control the land with an option rather than buying it outright before the utility work is understood. Third, obtain realistic power studies and define who pays for the substation and network upgrades. Fourth, design the facility around the expected density and cooling requirements of actual customers. Fifth, secure an anchor lease or a development agreement, and only then finalize the permanent capital structure. You can enter through 3 ownership models. You own the building, operate the facility, and sell capacity directly. This offers the most control and potentially the strongest margin. It also requires the most operational capability. You control land, power, permits, and early design, then sell the project or bring in an operator and institutional investor. You create value by turning an uncertain parcel into a buildable, financeable site. You contribute development expertise, local relationships, or operating capability, while a larger capital partner provides most of the equity. This is how many hyperscale projects become possible. At 100 megawatts, the question is not whether you personally have $1 billion. The question is whether you can assemble a project that a pension fund, private equity firm, bank, and investment-grade tenant all believe should exist. And notice who is missing from that first conversation: the AI engineer. The first critical hires may be a utility interconnection specialist, electrical engineer, permitting attorney, construction team, and leasing executive. The servers come later. Because this business does not begin with computing, it begins with permission to consume power. So, after all of that, what do you actually own? The customer owns the GPUs. The utility produces the electricity. The telecom companies operate the networks. The bank may own most of the building economically until the debt is repaid. You own the contracts and infrastructure that hold those pieces together. That can be enormously valuable. American data center demand has expanded faster than available capacity. Construction costs have climbed. Large customers are reserving buildings before completion. And access to power has become so scarce that developers are buying or partnering with power generation businesses to move faster. Reuters cited a Goldman Sachs projection that U.S. data center power demand could rise from 31 gigawatts in 2025 to 66 gigawatts in 2027. But scarcity does not remove execution risk. It magnifies it. When every megawatt is valuable, a delayed transformer is more expensive. When every project is larger, a bad loan is more dangerous. When communities believe the grid is being built for private AI companies at public expense, a permit becomes political. And when one customer supports an entire billion-dollar campus, one contract can determine whether the building is an asset or a monument. You began this video wanting to own the place where artificial intelligence lives. Now the business looks different. You are not betting primarily on which AI model wins. You are betting that a customer will still need your location. your power and your cooling long after the current generation of chips becomes obsolete. The concrete protects the machines. The contracts service the debt. And the power position creates the value. The servers create the headlines. The megawatts create the business.